Shorten's super slug stumble. Morgan Stanley thinks the stock market's going down and why we think they're wrong and the market's going up. I'm Peter Switzer.
I'm Paul Rickard.
And we're
mad about money.
Okay, Billy Shorten, he's the favourite to win the election. He's like Winks, 200 metres ahead with only 100 metres to go. And he's had this super slug stumble, Paul.
I thought you did well there, Peter, but I'm going to say silly Shorten's super slug stumble. Of course, that's all about...
Don't be biased.
Don't be biased. That's, of course, there are a number of changes that the ALP is proposing for superannuation, which Bill Shorten forgot about yesterday. But these
he said no new taxes on super, but he's already got them there.
These are going to affect millions of people. And then the big one, of course, is there's a cut in the non-concessional cap from 100,000 back down to 75,000. That means that if you're doing things like the one-off contribution, Peter, it comes down from 300,000 to 225,000. Just to put that $75,000 in context, that was $180,000 in 2007, and here we are talking about in 2019, coming back to just $75,000.
And retirees who have low super balances and sell a house and trade back, they often use that extra money to whack in the super so they can live comfortably. This is a real slug for those people with low super balances but own a house.
Yeah, he's also getting rid of the catch-up concessional contributions, which was something to help particularly low-income balance and people when partner might be out of the workforce.
Yeah, like a woman's had a baby, been out of work for 3 or 4 years.
And the biggest change that was announced 2 years ago, and that was allowing everyone to effectively get the deductibility of the first $25,000 worth of concessional contributions. Now, where that became really important is for most of us, if you're employed, it doesn't make any difference. So you get salary sacrifice, but not everyone can salary sacrifice. Not all employers offer it.
Yeah, that's true.
And for a lot of self-employed people, you know, they don't have access to those things, and people working at home might be doing a bit of part-time casual work. You know, they could then claim the tax deduction. So that's where you get sort of 1 million people impacted.
Yeah. And there are a lot of labour those sort of people.
These changes largely affect lower income people. So Bill just forgot about that yesterday. He forgot about a few of his tax promises, and you know, it's a super slug stumble.
Okay, but also one quick one: the higher income earners on 250, they pay 30% on their super tax contribution.
Yeah, so there are some higher income earners impacted, Peter. So that 250,000 current cap at the moment, where you pay effectively 30% of contributions.
On all your contributions?
Yeah, on all your contributions, that comes back to $200,000. So look, it impacts more people than it looks like, and he's just sort of quietly forgotten that these policies were announced over 12 months ago. They're there, they're amongst their tax plan, they're all on their costings.
And he kind of forgot about it at the press conference yesterday.
And then sort of denied it. So look, I mean, that's one of the challenges of this government. It is investor unfriendly. It is saving unfriendly, and you know, you've got to weigh up as an elector. You know, what's more important.
You know what? Bill has become like the tax commissioner, just looking into all the rocks to see where he can tax people more. He might get hated because of it. Morgan Stanley, Paul, came out with a call that our market's going down to 5,800.
Well, this is one of analysts. This is the sort of strategy analyst at Morgan Stanley. I have to say the record of Morgan Stanley in this stuff is pretty ordinary.
Yeah, that's right.
But they're talking ASX at 5,800. Their argument.
Where are we now? We're at 6,000.
We're at 6,200-ish, right? Okay. So the argument going is they're a little bearish still on banks, not super bearish. They quite like the resources mainly because of the impact of iron ore. This is all because of Vale, right? No one knew the tragic accident of Vale was going to happen. That's why iron ore prices where they do. So they sort of basically those two sectors sort of neutralising each other, and then they're bearish on the rest of the market, mainly sort of the consumer and staple sectors, saying, well, you know, consumer confidence is a bit down. There's the housing impact going on, and so in that environment where sort of resources go up, banks come down a bit, the rest of the market will also go down. That's what puts it down. Look, I mean, I don't buy the analysis, Peter. I think the market looks okay, but look, I think we're back into that sort of. I'm not a super bull either. I think we're in a trading range, and the range is going to go up, and we're in a grind. And so when you go up to sort of 6,300, expect a pullback at some stage, and then we're going to do a lot of work. Yeah. What do you think?
I think we're crawling higher.
Yeah.
And I think you're right. There'll be a pullback at one stage. But I do think, and we probably go, can someone ring the bell? I want to go to the next point. Thank you. So I think this is relevant because you and I both think the market's going to go up. We think Morgan Stanley.
That's called a bell stumble, but I can't think what the alliteration around that is, right? Yeah. That's a bell ringer's glue.
Our bell ringer's a ding-a-ling. But let me tell you this, Paul. I just think if you put together the fact that I think Donald Trump's trade wars deal will give us a leg up. I think after the election there'll be a post-election kick up because everyone's apprehensive before. Even if Bill wins, I think the market still get the relief that, okay, all the stuff's out of the way. I also think Bill Shorten will be helpful for the market until January 1 because he's going to cut the capital gains discount and he's also going to introduce negative gearing. So a lot of people could chase stocks and property before that capital gains.
Absolutely right, Peter. I mean, if somehow the coalition gets back in, that's good for the market because the market will be relieved because they're pricing in a Labor government. Yeah. Bill gets back in, well, we have all the impact of his changes, and that's going to encourage investors to do things between now and January 1, particularly if he's able to get the capital gains tax. That's actually the big sleeping... People are talking about the other changes. That's the biggest change of anything he's got, I think, because effectively, if you're a high income, you're paying tax at 47%, soon to be 49%. If you buy something on the 31st of December 2019... You can effectively have the asset fall by 18% before you're the same as you bought it on the 1st of January 2020. So the market, there's a huge reason to actually do things before the 31st of December, and that could cause a bit of a problem for the market in the first quarter of next year.
Because accountants and financial planners and business press will all be telling people, you want to get in because if you buy something before January 1, you have this 50% discount rather than 25% after Bill.
And it makes a huge impact if you look at the difference in how much the asset has to go up in price. So it's about 18% different for a taxpayer paying 47%.
Yeah, so that could be a reason why Morgan Stanley is wrong because Bill Shorten could actually create a little mini boom.
He could
short-term boom. A Bill Shorten short-term boom.
You work on that alliteration, Peter.
Yeah, that's what I expect. I'm Peter Switzer.
I'm Paul Rickard.
And we're
mad about money.